This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Today, we discuss the latest tax provisions aimed at seniors, including a new $6,000 deduction that could mean little to no taxes on Social Security for many retirees. We also unpack the crypto tax changes buried in the big, beautiful bill, highlighting a key shift in how wash sale rules apply. Plus, a deep look at market patterns, the risks of an overvalued U.S. stock market, and why Gen X's lack of retirement confidence may be justified, but not irreversible, with smart planning. David, now you and Josh touched on this matter, but let's flesh it out a little more. The headline is, this is a headline from CNBC. Republicans' big, beautiful bill touts tax help for seniors on Social Security. Now, you noted with Josh that Trump had a no-tax campaign promise on Social Security. That isn't what was done, but what was done?
Yeah, so seniors are getting an additional $6,000 deduction. So a married couple, that's $12,000. So, and standard deduction went up this year as well. So a lot of people don't realize standard deduction was $15,000. It's actually $15,750 now for 2025. So everybody got that. Everybody got an extra $750 of non-taxable income this year. So basically a married couple now has got close to $45,000 if they're over 65 in standard deduction. Well, the average married couple is only collecting about $52,000 in Social Security. And because the difference there it is below the threshold, they basically effectively are paying little or no tax on that Social Security. And again, 8 out of 10 seniors that are already on Social Security over 65 will no longer pay tax on their Social Security. So he kind of got it done, but here's the caveat. Like many of the provisions in this bill, again, you're going to want to watch the our probably 30 or 50 minute long, who knows, when we go through this video we post on the YouTube channel. It's temporary. So the tax is coming back. And even the provisions that say are permanent, i.e. the tax brackets, well, if you've studied history as we do, Chip, we know none of that is permanent, right? It's until we get another elective body that changes the legislation and tries to go a different way. And now because of this, we're going to have $45 trillion in debt by 2032. So how long do you think we can keep tax rates here? I'll leave that up to you.
I'll try not to think about that. David, there is a crypto tax bill working its way through the system, and you said your eyes went blurry reading it, but you did read it, and you shared with the team a summary.
It's actually part of the bill. This is law.
This is part of the big, beautiful
bill. So
what's
one of the many provisions.
What's the crypto tax?
Well, so crypto tax, they're basically eliminating what's called the wash rule. So if you bought a stock today, Chip, held it for, say, 8 months, and sold it at a profit, then bought it back 3 days later, and then sold it again. If you don't stay out of that position for 30 days, we consider that one transaction. In other words, so there's what's called the wash rule, where if your taxes can get quite complicated if you're day trading or what have you. But so basically, with crypto tax, there is no wash rule. So you could buy and sell crypto, and the reason is they're trying to actually make it into currency, which I've talked about. Cryptocurrency is not currency. It's anything but. However, now with the advent and the rulings on the SEC and the Supreme Court on what's called XRP or Ripple, the stable coins, those are going to become very, very prevalent very quickly in cross-border transactions. And so people are going to be buying and selling these things daily, corporations in particular, to transact foreign currency exchanges, all kinds of things, and move money around. So if they were going to be treated like stocks, where there'd be all kinds of complications tax. So that's why they had to put in there. But this would lead to a potential benefit, a tax benefit for someone that does trade crypto. And there are many people out there. Again, we're not advocating you go buy or sell any of this stuff. But again, I just look at the bill and interpret what the data means and tell who's going to benefit and who won't. That's what our job is when it comes to tax planning. So it is a unique provision in there, and that it did catch my eye.
The analysis that we do here, David, it's not throwing darts at the wall. It's not a crystal ball. You and all of our advisors and the support staff study data. You study patterns. Well, let's look at what's happened, because the past is prologue. A lot of times you can predict what's coming by what has happened before. And so I thought of all that when you sent the team a chart. This is about so-called gaps in the S&P 500 and then how they're filled and what it means for the economy. Take us through this.
All right, so what we have on the screen is a weekly chart using my favorite charting statistical way to look at it, which is called candlesticks, right? And when you chart with candlesticks, and you can do this by minute by minute, second by second, tick by tick, daily, weekly, et cetera. So I like to look at weekly for long-term trends, and each candle represents the action of the market within the week, the particular week you're looking at. Well, when we have a gap up or down, gaps sometimes get filled. Traders like to see gaps filled. In other words, so if you go back here to the first week of May, around May 5th, the S&P gapped up a pretty good couple percentage points to start the following week, right? So we were coming out of the tariff tantrum, if you will. And then we had news that, okay, we're going to, pause tariffs. And that next week, the market gapped up a couple percentage points. So the second week, so if you look at the week of May 5th to the week of May 12th, there was a pretty significant gap up.
All right. So the upward trajectory that we see in the candlesticks.
And in other words, you see a gap, the close of one to the open of the other. There's a gap in the chart.
All right.
So every weekly gap up going all the way back to 1981, before half my employees, probably 75% of my employees were even born, maybe 85%. Scary thinking about this. We're getting old.
They keep getting younger and younger.
Every one of those gaps has been filled. In other words, the market comes and fills those gaps. It just has a unique, now again, that's a technical analysis. No guarantee it will happen, of course. But if you don't learn from history, you're not going to, it is, as you said, it's a pretty good precursor of what's going to happen. So why would that gap be filled? And that gap was down around 5,800 points. The S&P is now cleared 6,200 all-time highs again today as of this recording, right? So that would be a good little drop, right, of almost 500 points on the S&P, 8 or 9%. You'd have to see the market pull back to fill that gap. Is it going to happen? Well, I can't guarantee it will. High probability it does. So another way to look at it is, how overvalued is the market? Well, technically it's telling you it's ripping to all-time highs. So I sent everyone on the team a chart just this morning, just showing you just how big the U.S. stock market has gotten. We've always been basically the largest market in the world, but we used to only be about 15 or 20% bigger than the other markets. We are now larger than the next 12 largest markets, stock markets on the globe.
Wait. Larger than the next
12 combined. We are over $63 trillion in value in U.S. markets.
Almost 64 on this total market cap
The next
chart.
12 are only about 53 trillion combined.
19, 17, 7, 5, 3.5, 3, 1, 1, 1,
so
1.
If that reverts to the mean, right? Again, I just, data's data. If it reverts to the mean, that would mean a 50+% correction in U.S. markets, the NASDAQ, S&P, Dow, all of them. Now, people think, oh, that would never happen. Well, it's funny, Chip. I've been doing this a while, as you often want to point out. I earn these gray hairs. We've had 2 market corrections in my career over 50%. So certainly it tells us, if we don't learn from the past, it's probable it could happen again. So again, I'm not saying that's going to happen. I'm telling you should have caution, especially if you're at the finish line. If you're 6 months from retirement, Chip, should you have all your eggs out in that basket that's at full risk? Certainly you need to grow your assets and have exposure to the equity markets to fight things like inflation, but you need to make sure you have somebody helping you risk manage your portfolio before you go walking into retirement just thinking everything is rosy because the markets are at all-time highs.
Now, that is a great segue to our final story, because I'm the tail end of the boomers, and you're the front end, I think, the front wave of Generation X, right? I'm born in 62. You're born in 68.
So I just want to make sure that
happy birthday, by the way. You just had a birthday.
I did, but I still want to point out that I'm not only even younger than you, I'm in a whole different generation. So I just want to put that on air.
One of my favorite moments, I'm the oldest of my 5 siblings, and when my brothers and I together, and said, so who's the oldest? Oh, I dine out on that for weeks. But anyway, all right. The headline from Fox Business is Generation X is not confident about retirement. That's according to a survey that was done. I'm just asking, do you agree? I mean, you know all about retirement, but are people in your generation not confident about retirement?
Yeah, because a lot of folks didn't do the legwork required to get themselves in position for retirement. Now, you got to remember, my generation is significantly smaller. There are less than 40 million Gen Xers when there were almost 90 million baby boomers, right? So we're a significantly smaller generation, less than half the size. And so a lot of Gen Xers were going to be dependent upon inheritance, was their plan, if you will. However, there is always time to put together a plan and keep the ball rolling forward. So if you haven't started planning, I would tell you start today.
Well, Rita Ossoff of Fidelity says in the story, planning does not stop at retirement. That is so true. So much of what we do here is post-retirement. Now let's make sure we're managing your assets and your risks, as you just noted, properly.
Yeah, I will tell you, a friend of mine works for one of the big box financial planning firms out there, one of the largest in the country, and they put together this big 3-inch binder and hand it to their clients in this little embossed thing, and that's the plan. And I'm like, well, how often do you go open the binder?
Right.
Never.
Yeah.
I'm like, well, so what was the value of that binder, right?
No.
It has little value. You must have a proactive plan and a planning process that's going to adapt and adjust to legislative changes, market changes, different optics, the client's changes, health changes. There are so many factors into planning pre and post retirement. And I just think a lot of folks, unfortunately, get it completely wrong.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.